Stop scrolling. Close those trading apps. What I'm about to show you isn't some conspiracy theory or leaked document. This is something far more powerful. This is the real data that the big banks don't want you connecting together. You know what's fascinating? While everyone's talking about Bitcoin, gold, and stocks, there's a metal that's been quietly setting up for the most explosive move we've seen in decades. I'm talking about silver. And no, this isn't your grandfather's investment advice. This is about understanding what happens when industrial demand, monetary policy, and supply constraints collide at exactly the same moment in history. Right now, as I'm recording this, silver is trading around $30 to $32 per ounce. Some analysts are calling for $50, others say $100. But here's what nobody's talking about. The math behind what's actually happening in the silver market is so absurd, so completely disconnected from reality, that when this thing breaks, it won't be a rally. It'll be a reset. Let me show you something that'll make your jaw drop. Let's start with the basics. Silver isn't like other commodities. It's not just a precious metal. It's not just an industrial metal. It's both. And that dual nature is creating a crisis that most investors don't even realize is happening. Here are the facts. Global silver mining production in 2024 was approximately 830 million ounces. Sounds like a lot, right? Now let's look at demand. Industrial demand alone consumed about 550 million ounces. Solar panels, electronics, EVs, 5G infrastructure, medical applications. Silver is absolutely critical to modern technology. You can't build a solar panel without it. You can't make electronics without it. There is no substitute that works as well. Then add investment demand, another 200 million ounces. Jewelry demand, 180 million ounces. We're already at 930 million ounces of demand against 830 million ounces of supply. That's a 100 million ounce deficit. The market is consuming more silver than we're mining every single year. Now you might be thinking, okay, but there are stockpiles, right? Yes, there are. But here's where it gets interesting. Unlike gold, which gets hoarded and recycled endlessly, silver gets consumed. When you use silver in a solar panel, that silver is gone. It's embedded in a rooftop somewhere for 25 years. When you use silver in electronics, it's dispersed across billions of devices in amounts too small to economically recover. According to industry estimates, humanity has mined about 1.5 million tons of silver throughout history. You want to know how much is left in accessible, investable form? Maybe 2 to 3 billion ounces. That's it. The rest has been consumed, lost, or is sitting in jewelry and silverware that nobody's melting down. And here's the kicker. We're accelerating consumption. The green energy transition alone is projected to increase silver demand by 15-20% over the next 5 years. Every solar panel, every EV charging station, every wind turbine uses silver. As the world moves away from fossil fuels, silver demand isn't just growing, it's exploding. So we have a deficit market, declining above-ground stockpiles, and accelerating industrial demand. That's recipe number one for a price explosion. But there's something even crazier happening, and this is where most people's brains short-circuit. The silver market isn't just physical. In fact, most silver trading happens on paper, futures contracts, ETFs, and derivatives. And the amount of paper silver being traded absolutely dwarfs the amount of physical silver that actually exists. Let me give you some context. On the COMEX, the major commodities exchange in New York, billions of ounces of silver are traded every month in the form of futures contracts. But how much physical silver does COMEX actually have in its vaults? As of recent data, around 300 to 350 million ounces. Now, not all futures contracts demand physical delivery. Most are cash settled. But here's the problem. The paper market sets the price for the physical market. Think about how absurd that is. The price of actual, real, physical silver that you can hold in your hand is being determined by a market where 100 times more paper silver trades than physical silver exists. It's like letting people who do not own houses set the price of real estate by trading house contracts back and forth. And this creates something called a premium disconnect. Right now, if you try to buy physical silver, actual bars or coins, you'll pay a premium over the spot price. That premium has been widening. In some cases, physical silver is trading 20-30% above the paper price. That tells you something critical. The people who want real silver are willing to pay far more than what the paper market says it's worth. What happens when that gap gets too wide? What happens when buyers start demanding physical delivery instead of accepting cash settlements? That's when the paper market breaks. Now, let's talk about who's buying. Because while Western investors have been distracted by tech stocks and crypto, the East has been quietly stacking silver like their lives depend on it. China is the world's largest silver consumer. They use it for industrial production, and they're also accumulating it as a strategic reserve. India has a cultural affinity for silver that goes back thousands of years. Every wedding, every festival, Indians buy silver, and India's middle class is growing by tens of millions every year. But here's what's really interesting. Central banks are starting to pay attention. We all know central banks buy gold. That's standard reserve diversification. But there's growing chatter that some nations are looking at silver as an undervalued monetary metal. Russia, for instance, has been accumulating precious metals aggressively. If even a few central banks start buying silver in serious size, the relatively small market would get overwhelmed instantly. Think about it this way. The entire global investment silver market is worth maybe $60 to $80 billion. That's nothing in the world of sovereign wealth. A single large country could buy up a massive percentage of available silver with what amounts to pocket change in geopolitical terms. And this brings us to a fascinating dynamic, the wealth transfer that's happening beneath the surface. For decades, Western financial institutions have controlled precious metals pricing through the COMEX and the London Bullion Market Association. But physical metal is flowing east. When the price reset happens, and it will, the countries holding physical silver will see their wealth multiply, while the institutions holding paper promises will be left scrambling. Let's talk charts for a second, because even if you're not a technical trader, you need to see this. Silver has been in a consolidation pattern for years, coiling tighter and tighter. Every time it tries to break out, it gets smashed back down. But here's what is different now. The fundamentals are so strong that the technical resistance levels are becoming irrelevant. We saw a preview of this in 2020. Silver went from $12 to $29 in just a few months. Why? A combination of monetary stimulus, inflation fears, and a short squeeze in the paper market. But that move was tiny compared to what's building now. The deficit is bigger. The stockpiles are smaller. The industrial demand is higher. The geopolitical tensions are more severe. When silver breaks through the $35 resistance level convincingly, there's very little standing between that price and $50. And if it breaks $50, which was the 2011 high, we're in uncharted territory. At that point, momentum traders, algorithms, and FOMO buyers flood in, and the move becomes parabolic. Here's a scenario that keeps silver analysts up at night. What happens if a large number of COMEX contract holders decide they want physical delivery? COMEX rules allow for cash settlement, but they also allow for physical delivery if demanded. If enough traders stand for delivery, COMEX has to produce the metal. Now, COMEX has inventory, but it's a fraction of the open interest. If even 10% of contract holders demanded delivery simultaneously, it would drain the vaults. And if the vaults get drained, COMEX would be forced to either default, change the rules to force cash settlement, or let the price explode until enough physical sellers emerge. There's historical precedent for this kind of thing. In 1980, the Hunt brothers tried to corner the silver market. They accumulated huge positions and demanded physical delivery. The exchanges changed the rules to stop them, but not before silver briefly hit $50. The difference now? The deficit is real. The industrial demand is structural. This isn't a speculative corner. It's a fundamental supply crisis waiting to pop. Let's talk about the elephant in the room, currency debasement. Since 2020, central banks around the world have printed money at unprecedented levels. The US M2 money supply expanded by trillions. The Fed's balance sheet exploded. And while inflation has cooled from its 2022 peaks, prices haven't gone back down. Your groceries still cost more. Your rent still costs more. Your insurance still costs more. Silver, like gold, is a store of value. But silver has something gold doesn't. It's undervalued relative to gold. And here's the thing about inflation hedges. They work best when you buy them before everyone else realizes they need them. By the time your neighbor is talking about buying silver, you've already missed the first leg of the move. This is the game changer that most traditional analysts are underestimating. The world is in the middle of the largest infrastructure build-out in human history. Governments are spending trillions on renewable energy. Every major economy has net zero commitments, and silver is essential to making that happen. A single solar panel uses about 20 grams of silver. Doesn't sound like much, right? But when you're talking about gigawatts of solar capacity, those grams add up to millions of ounces. The Solar Energy Industries Association estimates that solar installations could consume 150 to 200 million ounces of silver annually by 2030. That's almost 25% of current global mine production, just for solar. Add in EVs, which use significantly more silver than traditional cars. Add in expanded electrical grids, 5G networks, and data centers. The industrial demand floor is rising every year, and there's no scenario where it decreases unless we abandon the green transition entirely. This creates a squeeze from below. Even if investment demand stays flat, industrial demand alone is eating into available supply. And when investors start piling in, where does that silver come from? It doesn't. The price has to rise until industrial users and investors start competing, and that competition pushes prices to levels nobody's currently pricing in. Now, I'm not going to sit here and tell you silver only goes up. There are risks. If we hit a major global recession, industrial demand could drop short term. If central banks somehow manage to normalize monetary policy without breaking anything, The inflation hedge thesis weakens. If someone discovers a viable substitute for silver in key applications, demand could shift. But here's my counter to those risks. Silver has survived every substitute attempt so far because its properties are unique. It's the most conductive metal, the most reflective metal, and it has antimicrobial properties. There's no single replacement. And as for recession risk, every recession eventually ends, and the long-term supply deficit remains. The bigger risk, honestly, is government intervention. If silver starts moving too fast, exchanges could change margin requirements, halt trading, or force cash settlements. We've seen it before. But even those interventions are temporary band-aids. The fundamental imbalance doesn't go away just because an exchange changes the rules. So we've covered the supply deficit, the paper market distortion, Eastern accumulation, technical setup, COMEX stress, inflation hedging, and green energy demand. Let me tie this together. We are at a unique moment where multiple massive forces are converging on a relatively tiny market. Silver's total market cap is smaller than many individual tech stocks. When institutions start taking it seriously, when sovereign buyers step in, when the paper market cracks, the move won't be gradual. It'll be violent. I'm not telling you silver is going to 347 or $500 or any specific number. Nobody knows. But what I am telling you is this. The setup is extraordinary. The risk reward is asymmetric. If silver does nothing, you've bought a hard asset that holds value. If the thesis plays out even partially, you could see multiples on your investment. And here's the beautiful part. You don't need silver to go to $500 to win. If it goes to $50, that's a double from here. If it goes to $75, that's more than a triple. Those are realistic targets based on historical ratios and current fundamentals. The question isn't whether silver will go higher. The question is whether you'll position yourself before the crowd figures it out. Look, I get it. Everyone's got an opinion on markets. Everyone's got a hot take. But silver isn't a hot take. It's math. It's supply and demand. It's industrial necessity meeting monetary chaos, meeting geopolitical realignment. The big players know this. They're not advertising it because they're still accumulating. By the time it's a front page story, the easy money has been made. So here's what I want you to do. Don't take my word for it. Go verify the data. Look at the deficit numbers. Check the COMEX inventories. Read the solar industry forecasts. Watch what China's doing. Connect the dots yourself. And if you come to the same conclusion I have, act accordingly. Whether that's physical silver, mining stocks, or ETFs, position yourself in a way that makes sense for your situation. Just don't wait for CNBC to tell you silver's hot. By then, you're late. This isn't financial advice. I'm not your advisor. But I am paying attention to what's happening, and what's happening is historic. The silver market is setting up for a move that we'll be talking about for decades. The clock is ticking. The deficit is real. The demand is growing. The supply is constrained. And the price is still asleep. When it wakes up, you either positioned yourself or you're watching from the sidelines, wishing you had. If you found this valuable, hit that like button. Subscribe if you want more deep dives into markets and money. Drop a comment telling me what you think. Am I crazy or am I onto something? And if you want my continued analysis, premium breakdowns, and real-time updates as this situation develops, check out the membership link below. No hype, no BS, just data-driven analysis. The silver story is just beginning. The question is, are you going to be part of it? I'll see you in the next one. Stay sharp.